My favorite investing quote of all time is, in the short term, the market is a voting machine. In the long term, the market is a weighing machine. I wrote this book to make people aware of what the heck the weighing machine part of that statement means. Everybody understands why stocks go up and down. Very few people know what causes the market to go up and down over the long period of time. Generally speaking, if you were to summarize that, the reason the stock market goes up is because...
Welcome to the Early Advantage 5 o'clock shout out edition. Tony Robbins, motivational speaker Tony Robbins, says that mastery of something is mastery of the fundamentals. That's so true, and it's so true of investing. And I can really think of no better person to explain the fundamentals of stock investing, well, say for my arrogant self, really no better person to explain the fundamentals of stock investing than Brian Feroldi, who calls himself a financial educator. He's the author of a book called Why Does the Stock Market Go Up? This is the title, but this is not the actual cover. I'm still waiting for my Amazon delivery to get the actual book. But Brian's all over social media, Twitter, YouTube, LinkedIn, wherever, probably platforms I don't even know about. I'm a Generation X guy. Anyway, and he's hammering home these messages about value investing, Warren Buffett style investing, finding good companies, holding them. Yes, some of it is like stuff a lot of us know, but it's the stuff we need to have pounded into our thick skulls. Well, not audience of the Early Advantage. We don't have thick skulls, but let's say everyone else does, or maybe I do. Anyway, Brian is preaching what needs to be preached. I'm happy to have him on the show. He talks about some of the key tenets for investing success in his mind and personal financial success in his mind. And he also talks about a share that he's liking, or he watches. I don't know if he's recommending it, but he likes it. Anyway, then we have Brian Christoper. Speaking of Brian's, maybe we get a discount package deal on Brian's this week. Brian Christoper is here with his Bloomberg screen of the week, and I'll let you see what kind of stocks he's talking about. So enjoy the show. My guest today calls himself a financial educator. He's an author, he's a podcaster, and he's a smart guy saying what I think needs to be said a lot more. His name is Brian Feroldi. He's someone I've kind of developed I'd call it a mild fascination around. I wouldn't call it a man crush, that's going too far, but mild fascination I think is a fair term because he says a lot of the things that need to be said about investing to the point that like I'm almost sick of them, but it's exactly what I need because it needs to sink through my protective logical layer and get deep into my subconscious. And that's why I respect him so much. He knows how to say it in a way that really makes it come alive in at least my brain and hopefully yours too after we talk a little bit more with him today. Brian Feroldi, welcome.
James, awesome to be here. Thank you for the kind introduction.
It is my pleasure. And let me give you a little stress right off the bat. Let's call it a warm-up lightning round, just kind of an icebreaker, a few questions, just so we can get to know you a little bit more. Dog or cat?
Dog.
Long walks or long talks?
Ooh, that's a really hard one. I'm going to
think
go with
about
long
that one,
talks.
Long talks. All right. Hope your wife agrees. Biggest dream you didn't achieve in life?
Wow. Owning a limo.
Interesting. You'll be a successful investor when?
I have enough.
I like it. You are also the author, Brian, of a book called Why Does the Stock Market Go Up? And apologies, I ordered it today on Amazon, but it has not come yet, so we must make do with this visual representation of why. Oh, there we go. A better, higher budget version of Why Does the Stock Market Go Up? In a nutshell, Brian, why does the stock market go up?
That's a slightly complex question that needs I needed to write down in a book. But if I was to summarize it quickly, my favorite investing quote of all time is, in the short term, the market is a voting machine. In the long term, the market is a weighing machine. I wrote this book to make people aware of what the heck the weighing machine part of that statement means. Everybody understands why stocks go up and down. Very few people know what causes the market to go up and down over the long period of time. Generally speaking, if you were to summarize that, the reason the stock market goes up is because stocks represent fractional ownership of corporations, and corporations derive their value from the amount of profits that they're going to generate now and into the future. So the goal of my book was to make that very simple connection between what the stock market is and the profits that the corporations generate, and why, hopefully, for the rest of our lives and beyond, both of those things will continue to go up.
Fingers crossed. Yeah, I mean, the way I explain it, if you look from caveman times until now, humanity has added a lot of value to society, right? With basically with technological improvements, maybe some productivity improvements, but basically technology more and more. And when you buy into the stock market, you buy into a piece of that, value addingness of humanity. It sounds like you, though, since you have a book on it, have explained it a lot more refined way than that. But at least that's how I picture it. It sounds like you would sort of agree.
That's a big part of it. That's a huge chunk of it. The goal of my book was to make people aware that what profits do and what stock prices do are linked in the long term. And I laid down 5 or 6 reasons why I believe profits should be able to increase indefinitely.
I'm glad you mentioned the word profit because if you just add value without in a way that requires even more value to add that value, then you're not really helping humanity, and your stock should not go up. So yeah, do it in a profitable way. That makes a lot of sense, and I'm looking forward to getting the book as soon as Amazon can bring it over here. Brian, let me shift to some of my first investing kind of questions. I don't mean to sound smug, but just to address the question, the subconscious mind kind of question, I think a lot of people watching this may be wondering is, why should people listen to you?
Great question. I think I do a pretty good job of making complex topics relatively easy to understand. But I'm very much an amateur investor, and I mean that in the best sense of the word. I did go to college. I studied business. I did get an MBA in finance, but I truly believe that 99% of the things that are in my brain related to the stock market were self-taught. I've read every book that I can get my hands on about investing. I've been a subscriber to The Motley Fool for more than a decade, as we were joking about before. I've been listening to your voice on podcasts for more than a decade now. And
I'm honored / embarrassed. Thank you, though. Yeah.
And I honestly think that some of the best education that I've ever gotten on investing was found on the discussion boards behind the Motley Fool's paywall. The number of people that they have attracted that are very intelligent investors that openly share information with each other, share lessons with each other. That's the kind of information I did not get in college, but wow, has that been incredibly valuable.
I feel very similar to you, Brian. I studied finance in college, and yeah, I mean, I learned NPV, DCF kind of stuff, but I honestly didn't really understand it at all, and I had no idea what I was doing when I started my first investing job at a hedge fund, and I feel like I had to really teach myself everything the hard way, but that was beneficial. You got to do it to learn, and then you learn oh my god, 90% of what I learned actually isn't super relevant, but 10% is super important. And so now I can discard and focus on that which really matters, at least in my version of the process. Let me ask you a question. I said at the intro, you say a lot of things that we've heard them, and as soon as I hear it, I'm like, oh, it makes total sense. It sounds so obvious, but yet, if you look at the data, if you look at academic studies, people Barbara and Odine, these two professors, I think they're still in California, do a lot of behavioral finance stuff. I mean, people don't follow those obvious things. In fact, they do the opposite. You basically have almost an emotional arbitrage advantage by investing like Warren Buffett, by staying cool, by not getting overly excited in one direction or the other. If God forbid, you were, getting, beamed up to the afterlife shortly, and you had to inscribe a few of your most important investing lessons or principles or understandings you'd like the world to take away. What would those be, Brian?
Well, if I was to, the first thing that I would point out has nothing to do with investing at all. And that is investing. How good of an investor you are doesn't matter if you don't have capital in the first place. A lot of the content that I create online is about investing and picking stocks because that's just something that fundamentally excites me. But I firmly believe that your personal finances are an order of magnitude more important than your investing finances. So I think everyone should spend time learning how to grow and diversify their income, how to cut their expenses, spend according to their values, and save, spending time paying down their debt, building an emergency fund, getting their proper insurance coverage, all that basic, boring blocking and tackling. The reason I think that is so important is because if you invest in the stock market, you are guaranteed to go through periods of immense psychological pain. Guaranteed to do so at some point. dealing with that psychological pain, dealing with the herd, dealing with the negativity that you hear out there, that is very, very hard to do. It is an order of magnitude more difficult to do that if you need the stock market to do something in a time period that you have set. If you're betting on the stock market to pay off a car or to pay off a loan, if you're leveraged in some way, it is so much harder to deal with the volatility that's going to come your way. That's why I'm a huge fan of the barbell method. And loosely speaking, what that means is keep your personal finances extremely conservative. Focus on those first. If you can do that successfully, what the stock market does on any given day, week, month, year, or even multi-year period is truly irrelevant because it has no impact on how you live your life. That's how I've structured my finances, and it just provides me with immense psychological satisfaction, and it also gives me the ability to deal with far more volatility than the average person can.
I love that. I love that. I feel that a mismatch of time horizon and investing expectations is the cause of 80% of stock market ills. What's your number as far as like people, if someone's going to put money in the stock market, what, just generally speaking, what kind of time horizon should they have? Like, for me, like I might tell somebody 5 years, like if you're investing for a shorter period than that, don't put money in the market because you might have a dip. What do you think?
Yep, that's exactly what I say. I say 5 years. The data says that over a 5-year period, I think it's 80 or 90% of the time, you can expect a positive real return in the market. That's a reasonable risk to assume. So yeah, but to me, anything less than 3 years, putting that money into the market is essentially gambling. So I agree with you. If you don't have at least a 5-year time horizon for that capital, it shouldn't be in the stock market.
Shifting into things philosophical, passive investing has grown in leaps and bounds. I think, I don't know this year, but passive investing assets eclipsed active investing assets in the stock market a couple of years ago. Is passive investing good for individual investors?
It's phenomenal for individual investors. I believe that 99% of investors, 99% of people that have money should, if they're going to invest in the stock market, should do so passively. Now, why do I say that? That's not because I think stock picking is impossible. That's not because I think that people aren't smart enough to invest their own capital. I say that because from what I've observed, only about 1% of the population is interested in the stock market, is interested in finance. And if you are going to invest differently than indexing should be the baseline. If you are going to be investing differently than the index, you have to have a high level of interest. You have no business picking stocks if you're not interested in learning how to read an annual report, read financial statements, learn the vagaries of accounting, think through biases, be able to judge management teams, listen to conference calls. Those are all table stakes for picking your own stocks if you wish to do so successfully. If you're unwilling to do those things, that is perfectly fine. Just put your money in index funds and call it a day.
Absolutely. Are index funds good or bad for the market overall?
Ooh, that's a tricky question to answer. They are definitely a good thing for investors in general, the average investor, right? Just investing passively, buying everything blindly. I've heard this the counter arguments just like you have, that eventually, well, if you're putting money in passive funds, there's no chance for price discovery. You're buying indiscriminately. Management teams have an incentive to conform their businesses to comply with capturing funds as opposed to running their business for any other reasons. There might be some long-term negatives if indeed 99% of people do index put their capital into index funds. But we'll just have to see that in the long term. And the more people that index, I think the more opportunity that creates for people that are willing to do individual stock investing.
Yeah, I agree. I mean, obviously, if indexing is bad for the market, then that's bad for individual investors writ large, but it wouldn't be bad for the whole market. It would just be bad for the passive indexers, and that would create further opportunity for the active investors.
Correct. Yeah, that's my view too, but I guess we'll figure that out in a couple of decades.
Exactly. We have time. Shifting to more specific questions. You, in your own portfolio, at least to my knowledge, have tended to focus on growth stocks. And this year, 2022, late summer, growth stocks are down. They've bounced back up a little bit the past month or so, but down writ large. With the benefit of hindsight, do you look back and think, oh, I was too heavily invested in growth stocks. I should have had some other stuff, or do you think with more time your focus will be vindicated?
Great question. Hindsight is always 2020. And I asked that question to my business partner, Brian Stoffel, today. I thought he just had a fabulous answer. He said, well, we are living in one version of history, one version that worked out. Imagine another version where Vladimir Putin had a heart attack in Q4 of 2022. What would the world be like today? What would valuations be like today? What would inflation be like today? The answer is they would look completely differently today than they were a year ago. If that was the case, what would growth stocks be doing today? There's a very real chance that they could be at least even with where they were, potentially even higher. You are correct that my strategy does tend to tilt towards growth stocks. By and large, I am looking at companies that I believe can significantly and substantially outperform the market over long periods of time. I want high returns on capital. I want to buy companies that can 5x, 10x, 20x my capital, at least have a chance of doing so. That's to say nothing. That's not to say that my style is best. Dividend investing, I think, works great. Value investing can work great. However, when I think about what I'm doing, I'm spending extra time in order to get something different than the market provides. If I was going after dividend investing, I think maybe if I did it really well, I could outperform by 1%, maybe 2% per year, perhaps squeeze out an extra 0.5%, maybe 1% of extra dividend return for me. To me, that would be a whole bunch of extra work for myself when I could just, again, index and call it a day and earn a 2% yield on my money. Conversely, I think that value investing would be the same sort of result. When I look at the thing that actually drives the long-term returns of the market, I know that it's a very, very small minority of exceptional companies that just deliver gangbuster returns that literally drive the entire market higher. And it's the game of investing is all about finding those extreme outliers and getting them into your portfolio. By and large, those extreme outliers tend to be companies that rapidly grow their sales for far longer periods of time than anybody can imagine. For that reason, that's why I focus on growth stocks. And I go in knowing that, one, I'm going to be wrong a lot. And two, if I can be occasionally really, really right, that's all that's going to matter.
Exactly. And finding those long-term winners while minimizing the bycatch or the number of losers that come into your net also, right? I mean, in the 1930s, we've had thousands of different car makers come and go in the US, and now we've got, 3 or 4. In the 1990s, we had hundreds of different e-commerce platforms, and now we've kind of got Amazon and maybe eBay, maybe a few other tiny ones. We've got thousands of cryptocurrencies right now, and I'm pretty darn sure we're not going to have that many in a couple of years, right? So every new industry is like that. You got a whole bunch of new entrants, and then almost all die or get bought out by the 1 or 2 big winners.
Mm-hmm. Yeah, that's correct.
So
that's just the nature of capitalism. But what I love about investing is, let's say I make 20 investments. I go in knowing I'm going to lose money on at least 10 of them. I'll do okay on 8 of them. And just 1 or 2 could be such massive winners that the entire process of spending that time finding those 20 companies will be worth it.
And something I saw actually on one of your live streams or Ask Me Anything broadcast, Brian, is you had a graphic with, I think it was Netflix, Home Depot, Amazon. At one point, Amazon was down 95% before it went up to rise almost 60,000% after that. A lot of these long-term winners were like massive losers for certain periods, and at that time, probably most everybody holding it felt like an idiot, and only the few who were patient enough to hold got those spoils. Now you got to contrast that thought, or at least buddy that thought, with the notion that there are a lot of Kodaks out there, a lot of blockbuster videos out there too that also go down 95% and keep going down the remaining 5 percentage points. That's life also. And just like with anything in life, whether it's a marriage, a job, a project, like the decision, should I keep waiting, keep trying a little bit more, or should I give up right now and cut my losses? That's one of the hardest formats of decisions to make in life. Do you have any specific guidance around how you make that decision in investing?
So I can actually share that picture. Yes, it's these are the returns. So these are the companies that are literally some of the biggest winners of the last 20 years, period. You could not do any better than buying these companies out there. And then here are the downturns. Here are the peak to trough downturns that these stocks put their investors through. The funniest thing about this chart is that Tesla is the least volatile of any of them. United Health Group down 90%, Amazon down 92%, Monster Beverage down 90%. And to your point, these are the best. These are the best. These are the top 1%. This, again, goes to prove what I said at the start of the show, which is just how important it is to take care of your personal finances. Because if you are going to get into the game of picking individual stocks, you can be guaranteed that something that you love is going to get smashed. Just absolutely smashed, clobbered for reasons that may or may not have something to do with the company. Charlie Munger said it best. Berkshire is down 50%. Four separate times throughout his history. And he was asked, does that bother you? And he said, no. He said, that just comes with common stock investing. And if you're unwilling to deal with that, you're going to get subpar returns forever. To your question about how do you tell if this is a temporary thing or if it's a long-term trend, that's a very, very hard thing to do. I'm going to say, of course, Amazon was going to recover. Of course it was going to do so, but that's resulting. We know the answer, and it seems obvious in hindsight. The same could have been said about pets.com if that one worked out, or any of the ones that failed miserably. This is why I spend an inordinate amount of my time focusing not on what the stocks are doing, but rather focusing on what the businesses are doing. I can't tell you what many of the companies that I own their stocks have done over the last day, week, month, year, or quarter, or year. But I can tell you what all of their earnings reports have said over the last a quarter or two. I can tell you the direction of their customers, my guess for the direction of the moat, the direction of their margins, and the direction of their new products. If those things are trending in the direction that makes me smile, then I'm pretty confident that eventually the stock will catch up, knowing that I'm going to be wrong a whole lot, and I'm going to hold a whole bunch of losers way too long. But doing that and going through that process of holding losers too long would be significantly outweighed by me selling the next Apple, the next Amazon, the next Netflix early.
And I think what you just said, I mean, if I were trying to explain the essence of successful investing to my son, I would pause that and rewind and make him watch that again, because like, it's what you're omitting. That's the key part. It's not just finding the business model you like, looking into the future, getting projections, falling in love with the company, thinking, well, we don't want to do that. But like, being familiar with the company and getting a model and a set of projections that you're comfortable with. It's holding to your belief. It's putting those city horse-drawn, the horses in the city have those blinders, they can't get scared by what's going on to the sides. It's putting those blinders on and holding to that belief when you've got warning signs flashing. You're an idiot. This is crazy. The market says you're wrong. Right? That's so hard.
Yep.
That's so hard to keep to that belief when you're getting like just such massive negative reinforcement. But those who can do that, and I would say that's one of the most important skills of investing, are the ones who make those 10,000, 20,000, 30,000% returns.
It's your I've heard it called your capacity to suffer. Not just in theory, in reality. And to your point, I wasn't investing during the dot-com bust. I was not an investor at that time. Looking back, it's very easy for me to say now, 2002, buying opportunity. So many great businesses were on a massive sale. But that's looking backwards and me just seeing an up and down a blip. I can't imagine how challenging it would be to be a tech investor starting in the year 2000 and then to have to live through 2 years in real time and dealing with you're wrong for 2 years in a row. We are currently, my portfolio peaked in February of 2021. So I'm about 15 months into my portfolio being down from the peak. And it's been pretty much pain. It's just been pure pain the entire way. But nothing has changed my resolve that I still want the vast majority of my capital in the stock market over long periods of time. And I remain optimistic about the future of all the companies that I hold, as well as humanity in general. But maintaining that positive attitude while you're but to your point, are the signals just saying you're wrong the entire time, day after day? It's so challenging.
Speaking of companies that you like or that you appreciate or you think maybe others should appreciate more, what's one or what are a couple companies that are kind of on your dashboard now that you'd like to talk about?
Sure. One of my favorites is one of my biggest winners of all time, well known to many companies, and that's Mercado Libre. The ticker symbol there is MELI. This is the eBay / PayPal / Amazon / Craigslist of Latin America. And this is a company that has been on the public market for a couple of decades now, has been a tremendous long-term winner, and even to this day is still growing at rates that make my jaw drop. This is a company that still has a huge opportunity ahead. There are still hundreds of millions of people in its core geographies now that are yet to come online. And this company has so many irons in the fire. I think it's built itself a nice moat. And boy, I believe it has a bright future ahead.
MELI is the ticker. Brian Feroldi, if someone is watching, and I suspect people are watching, and their feelings fall somewhere between that fascination and man crush level, they want to learn more, they want to know more about you, where can they go to do that?
Sure. The easiest way to connect with me is on Twitter. I'm at Brian Feroldi. I'm very active on that platform. If you're interested in individual stock investing, you can check out my YouTube channel, which is also my name, just Brian Feroldi.
Easy enough. Brian Feroldi, thank you very much for taking the time to be here with us, and thanks to you guys for watching at home.
Thanks for having me, James.
Hi there, I'm Brian Christoper. I write the Follow the Money newsletter at South Bank Research. And today we're returning to a topic that we've addressed previously in these videos because it's that important. But first, did you know that one of the names I mentioned in the 13 July video is up 67% since then? We can't give you definitive guidance on all of these names. Our paying subscribers wouldn't be okay with that, but these are real ideas that you can benefit from. And if your issue is that you still have stuff to learn, then post your questions in the chat. If the regulators allow us to answer them, we'll do our best to do so. Back to today's topic. It's a repeat, but we wouldn't bring it up again if it wasn't that important. It's inflation. Everybody's scared of it for good reason. Inflation increases the cost of the items you buy. As such, it diminishes your purchasing power. The value of your currency erodes. So what should you do about it? I suggest you do the obvious thing. In these videos, we consider the situation. Today we have an inflationary environment and central banks are increasing rates. We enter some inputs into our system and tell you what may be a solid strategy for confronting it. Per an essay published by the U.S. White House in July 2021, I learned the last historical comparison to today's inflation took place from July to August 2008. I looked for the best performing stocks in Europe, North America, and Latin America over this period. During this period, 58 stocks generated returns of greater than 50%. Does it surprise you to learn that 11 of them were banks? They were all from the US and Europe. Think about it. When central banks increase interest rates to fight inflation, the banks are beneficiaries. The rates at which they lend money rise. That means so long as they can increase the rates they charge for loans by more than they have to pay their customers, their margins rise. They make more money. But these days, based on what I hear from the media about banks, it doesn't seem like anyone cares. I was interested to learn if that was the case. Are bank stocks improving, but not moving? I ran a Bloomberg screen searching for banks in the countries we follow the most, the UK and the continent of North America. I searched for banks with a market cap greater than 100 million US, whose net interest margins are on the rise. That's when we want to buy bank stocks, when the amount of money that they're earning is rising. You'll also note I included one other metric, the efficiency ratio. A bank's efficiency ratio is its non-interest expenses divided by its revenue. The lower, the better. These are the expenses it has to pay regardless of interest rates. If these are low compared to its sales, that's good. An efficiency ratio of 50 or less is attractive. That took us down to 43 names, so we downloaded them and kept cutting. Next, we ranked the companies by those who had seen the greatest increase in both net interest margin and free cash flow yield. We took the top 6 names. Our top 2 scoring banks are from the Republic of Georgia. The second 2 have market caps under 300 million US, and the last 2 couldn't be much different, but they all met the criteria of our search and scored the highest. I don't doubt the process. These are the names we were looking for. So the first 2 names confirmed our thesis. They have already been moving higher. These are 2 of our 3 London-listed firms. They're both seeing solid sales growth. Well, after they took a hit, that is, because the share prices of both TBC Bank Group, that's TBCG on the LSE, and Bank of Georgia Group, that's BGEO in London, they both fell after Russia invaded the Ukraine, but they've come back lately. And while the numbers look good right now, you'd have to do a complete risk assessment given the proximity of the war to consider investing in these names. Our next 2 names also have similar 1-year charts. Rate increases have increased margins at OP Bancorp, that's ticker OPBK in the US, and Bankwell Financial Group, that's ticker BWFG in the US. The promising thing to me is they're still trading below their year-to-date highs. These are our 2 smallest names, but they are generating some solid sales growth. Per Bloomberg, both have a price-to-earnings ratio of less than 8, and shares have started to respond to the rate hikes. What a mix of names. Our final pair of stocks includes Lloyd's Banking Group, that's LLOY on the LSE, and I doubt many have superimposed its share price against that of North Carolina-based Live Oak Bank shares. That's ticker LOB in the US, but we're doing it. Live Oak lends to small businesses. Its second quarter sales were up 47% versus the prior year. Yet, its market cap is less than 1/20th that of Lloyd's, which offers tons of banking and financial services. The companies are very different, yet the charts are similar. Not the same, but similar. Lloyd's pays the largest dividend yield of any of these 6 companies, while Live Oak pays the smallest. That said, we know Lloyd's shares have struggled over the years, and it's basically been range-bound since the end of 2008, though you can make some money if you time it well. Lloyd's continues to try to recoup its 2015 highs. Today it trades at a price-to-earnings ratio of less than 7 and offers value on paper, but I'd like to see a confirmed uptrend here. It has popped from its recent July low, but shares are weak over this past week. This is a complicated entity, so it will require more vetting. All of these do, but they passed the first tests, or screening. That's positive. I've offered you a range of well-run banks that have begun to benefit from increased net interest margins. Feel free to include a note in the comments if any of these appeal to you and why. One final note that I'll pass along, the smallest 2 names, OPBK and BWFG, show the most consistent insider buying of the 6. I mention it in case that appeals to you. We're constantly on the watch for insider buying in my newsletter, Follow the Money. That's because insiders know more than anybody else about the companies that they run. Thank you for watching.